Good morning. I'm George Wilson, Chief Investment Officer of the Boston Foundation, and I'd like to welcome you to our annual investment review. First, I'd like to outline our agenda today. We'll start off with a brief overview of today's investment landscape and the investment options we offer. Next, Bill McCarron, President of Prime Buchholz, our longtime investment consultant, will go over the returns generated by the pools we manage. Finally, Mike Acton, Head of Research for AEW Real Estate, a Boston-based global real estate firm, will then give an overview of the U.S. real estate markets and our investment with his firm in the AEW Core Fund. Our investment activities are overseen by our investment committee, which is made up of a group of terrific people, as you can see as outlined on this slide. As I mentioned, the committee and I are assisted by Prime Buchholz Associates, a locally based institutional consultant that has been working with us for over 20 years. Historic low interest rates continue to be the story in the world today and their impact on return expectations for all asset classes. When I look at this slide, it certainly makes me feel old, as I got in the investment business in 1980 when the 10-year peaked at 15%. Well, the Fed has finally started to increase rates. As you can see by looking at this chart, U.S. rates continue to be near historic lows and are just bouncing off that 1.8% historic low by just a little. The amazing thing is that U.S. rates are actually high when you compare them to rates in other countries. Switzerland's interest rates have been negative for years and finally went positive and have turned up to a whopping 4 basis points, which rivals Japan's at 5 basis points. Just incredibly low rates. The thing that sticks out to me, equally, however, on this chart is that Germany and Italy are all still borrowing at rates that are significantly lower than the United States. The Fed has indicated it will continue to move U.S. short rates up, but it's not clear to me just how far up the long rate can go. This view is shared in the interest rate forward markets, where the 10-year Treasury trades in the 3% range for the next 5 years. After flirting with deflation in 2008 during the global financial crisis, U.S. inflation rates have finally hit the Fed's 2% long-term target, which has allowed them to start to move interest rates up over the past year, with more interest rates hikes signaled as recently as yesterday's Fed announcement. On to the equity markets. 2017 sure was an interesting year, and not just on the political front. In spite of many predictions that if Trump was elected president, that the U.S. stock market would crash, the opposite occurred. And 2007 was a terrific year for the markets, again, up 22%. A few years ago, we were fortunate to have Jane Mandillo, former CEO of Harvard Management, speak, and she gave a terrific presentation titled Expect the Unexpected. I've adopted Jane's title for my standard response to forecasting stock market returns because, as you can see, there can be some very wide volatility here. It sure has been a great run for the U.S. stock market since the financial crisis of 2008, with no down years since, 9 years of green, and let's hope this positive trend continues. Another way to look at returns are this chart I ran across a few years ago, and I think it's another way to look at just how market returns bounce around. The first thing that stands out to me is just what an outlier 2008 was, down 37%, which was one of the worst years ever. And when I first saw it on this chart, I just didn't realize that it was rivaling what happened in 1931 and 1937. The other thing that was really amazing to me is just how often the market's up 20% or more. When I counted the years here, it's actually more than 40% of the time, offsetting some of those very negative years. So 2017 really wasn't that unusual a year because it happens more frequently than we all realize. Emerging markets finally stormed back last year, up 37%. It's the first time since 2008 that the international markets have done better than the U.S. markets, and this is reflected in the 10-year returns, which are simply dismal for the international markets. As you can see, the 10-year numbers there were only 2% for both the developed EFA markets as well as emerging. But if you look closely at this chart, you'll see, amazingly, that emerging, while up only 2% over 10 years, were actually up 12% over 15 years. So a difference in your time horizon can actually lead to very significant and differences in your return expectations. So it just points out to me the importance of staying the course on your investment strategy and avoiding market timing at all costs. Another way to look at stock market returns is rolling 10-year returns, which is shown on this slide. As you can see, if you start on the left side, the rolling 10-year returns for the U.S. stock market were the best for about the 10-year period that started in 1997, as evidenced by the light blue line on the graph at the top there. Emerging markets then annually started to outperform the U.S. markets beginning in around 2002 and for the 5-year period ending 2007, resulting in the green line popping up there. And you can see that for a fairly significant period, emerging markets trailing 10-year returns were the place to be. And then the lines switch again right after the global financial crisis, and the U.S. markets have been the place to be until last year, for the last, really since 2009. Just a few comments and slides on where we are in this investment environment. It's simply been an amazing run since the fear and chaos of 2008. The economy, particularly here in Boston, is doing terrific. It's now approaching the longest equity bull market since World War II. We're just a couple of months from reaching that sort of historic record. As you would expect, we're also approaching one of the longest economic expansions since World War II, sort of hand in hand with what's going on in the stock market. From a valuation perspective, we were looking a little pricey for a while if you look at just the PE ratio, but not anything close to what occurred in 2001 during the dot-com era. Until the recent, and things were a little bit above average until the recent market correction, and we're now getting sort of close to historic averages from PE ratio over the last 20 years. So things don't look too far out of line. And lastly, as many know, last year was a year for historic low volatility for the markets, with the U.S. market up every month, which was a record. Unfortunately, that string ended in February, and you can see vol really spiked sort of more typical average levels. So it's not, while it seems volatile, it's actually getting more back to the norm, given that we were at such a low level for 12, 15 months. On to the investment options we offer for donors. The Boston Foundation offers 3 primary investment vehicles for our donor-advised funds to utilize. The Balance Plus pool, which is on the left of your screen, is where the vast majority of our assets are, representing roughly $970 million of the $1.2 billion that's been entrusted to us by donors. As you can see, it's a diversified mix of equity-like investments, with about 90% of these having equity-like returns and the remaining 10% in U.S. Treasuries. And we're well diversified across a variety of asset classes, including public stocks, private equity, flexible capital, known as hedge funds to most investors, real estate, and fixed income. This pool is where the Boston Foundation invests its endowment assets and where the majority of our donor-advised funds are also invested. The Balance Plus pool, which is in the middle of the page, is a slightly more conservative option that is also well diversified. The key differences is that it has 25% in fixed income versus only 10% in the Plus pool, and there's no private partnerships in here. No private equity is the big difference. A few comments on trends in the pool over the last 15 years. We got control of our assets from the original trustee banks in 2000, and the portfolio we inherited in 2000 was all public securities, 70% in global equities and 30% in debt. And over the last 15 years, we've gradually but consistently moved this to a much more diversified portfolio. As we sit here today, we really don't expect any large-scale changes to these allocations, other than to slowly grow the private equity allocation as we can locate new attractive investment opportunities. On the socially responsible front, we offer 4 mutual fund options for donors to construct their own portfolio, because this topic can mean very different things to different people. So we wanted to give you a lot of flexibility as to your options, as to building a portfolio that works for you. Just a few words on future returns. In looking at pricing of assets today, it sure looks like we're in a low return world for a while, really driven by the 10-year Treasury at 3%. This drives the pricing of all other asset classes to really pretty low historic anticipated rates of return, and we'll hear from Mike in a few minutes about the impact on this in the real estate markets. These are Prime Buchholz's forecasts, which are very similar to most other forecasters. And what the bottom line is that most asset classes are expected to deliver a real rate of return that's sort of in the 4 to 5% range. And plus a couple of percent of inflation. For inflation, we would expect the portfolio to deliver something in the sort of 6 to 8% range, with the 7% sort of in the mid range of that, or the 5% you see at the bottom of the graph plus 2 for inflation today. With that, I'd like to turn over the mic to Bill McCarron, president of Prime Buchholz. We at the foundation enjoy a terrific long-term relationship with his firm, and Bill will now go over with you the performance of our investment pools. Bill?
Great. Thanks, George. It's good to be here. I'll turn your attention to the next slide, a little overview of Prime Buchholz. We are heading into our 30th anniversary in October, and we are based in Portsmouth, New Hampshire, with an office in Boston. Owned by 23 shareholders. We've got a deep team with over 100 professionals and support staff, advise on about $50 billion worth of assets, 80% of which are endowment, foundation, and healthcare assets. The partnership with the Boston Foundation has been very important. I've worked on this relationship since the inception, and Jeff Croto, one of the other partners of the firm, is also intimately involved. We attend all of the investment meetings, and the partnership with George has been great. For performance, the long-term performance has been good and positive, contributing to the overall growth of the Boston Foundation. When you look at the primary pool, the balanced plus pool, you can see in 2017, the objective was achieved with a 14.6% return. Again, the stock market was very strong. That contributed. We also had positive performance in terms of flexible capital and a number of other areas. The longer term results, you can see, with the exception of the 10-year, which includes the financial crisis, the returns have been well in excess of expectations. The balanced pool, with the lack of private equity, still had a very positive result of 11.9%, and that's about the spread that we would expect taking the private equity out of that structure. The short-term pool is basically in there for very risk-averse donors and generally people that are expecting to make grants. So that's invested in cash. The structure, what's worked well, the domestic equity was the driver. Adage is our single largest manager. They outperformed, and the domestic portfolio has beaten the Russell 3000 by 1.7% annualized for 10 years. If you think about, in this environment, the majority of active managers have underperformed, so the structure, both with active and passive, has outperformed by 1.7%. That would certainly rank well. You've got exposure to global equity. Generation is a socially responsible manager added in 2014, outpacing their benchmark by 7% annualized. So that's been a nice addition. FlexCap, which is our term for hedge funds, the largest allocation is Buchholz. Recently, the performance has been low, but on a long run basis, our performance here has been very strong. And Varde, the second largest manager, is the best performing manager over the past 1 and 3 years. The private equity, which got started early in the process, has now grown, and we're going to continue to grow that allocation, and the performance there has been exceptional. We have a great list of managers, including, as you can see, Advent, American Securities, Bain, Berkshire, Charles Bank, and Legacy. And we continue to look to add quality partners. The inflation hedges have been the main detractor to performance, with some timber and energy investments have been lackluster, and the allocations to these areas have been reduced to 10%. And on a long run basis, or at least most recently, until the last year, international emerging exposure has detracted from overall performance, but certainly we expect the international and emerging markets will continue to contribute. Give you a listing of that on page 24. You can see global equity has been the strongest. Private equity last year, remarkable, almost 15%. Flex cap, which is our hedge position, up 6%. Real assets down, and sovereign debt very conservatively positioned with 0.2%, but the 15 years, amazingly, still a 5% overall return. We show you a 65-35 benchmark, and then the other benchmarks for your consideration. First quarter, as George mentioned, volatility spiked. We had a modest loss in the first quarter. The balance plus pool was down 40 basis points, and you can see the 65-35 was up 0.3, and the balance pool was down 50 basis points, but again, a very short-term period. We reported all the results you looked at earlier were for the calendar year 2017. And now I'll turn it over to Mike.
So I'd like to introduce Mike Acton, who's now going to give you an overview of the U.S. real estate markets and our investment in the AEW Core Fund.
Great, thanks, George. Good morning, everyone. So the title of my section here today, of course, is Current State and Near-Term Outlook for U.S. Property. The U.S. economy, as George mentioned, is well into this current cycle here. We're about to become the longest expansion in post-war history. Growth for the near term, next 2 years or so, is expected to be a little bit stronger than we might have thought a year or two ago. And this is largely because of the big tax cut package and the increase in federal spending that's just been approved. That has some bigger implications for longer term in terms of the deficit and so on, but for the near term, this will be positive for property. The U.S. property markets today are generally in a very sustained equilibrium. And what I mean by that is new construction is being at a level that pretty much in step with new demand for property. And we'll get into the numbers in a minute. Property earnings, what real estate people would call net operating income growth, has been very, very good. Real estate is very much a late cycle asset class. In other words, we have our strongest performance very late in the economic cycle, and that's what's happening right now. Year over year, net operating income growth in U.S. commercial property has been running at about 5% a year for several years in a row. It's not going to drop off rapidly, but it's not going to accelerate from here either. And I'll explain a little bit more about that as we go forward. And go forward returns are just simply going to be lower. As George mentioned, we're in a very low return environment. All of the easy returns, if you will, coming out of the financial crisis, recovering in values and so on, that's been very good. Our clients like it very much. But that's all behind us now. And go forward returns are simply going to be lower. And they're going to be largely shaped by the speed and degree to which the interest rate and credit environment changes in the U.S. Now, before we get into the actual real estate markets today, I think it's helpful for everyone to take a step back and think about the U.S. property market in a much bigger context and why you would want to invest in it. Our business is a very, very simple business. We provide space to people for where they work, where they live, and where they recreate. It's really that simple. More people is always better than fewer people as far as we see the world. And the U.S. population is one of the few growth markets in the developed world today. Population growth in percentage terms is, of course, slowing. That's what the red line on this chart is showing you. But the quantum of population increase coming off the large base, the U.S. today has about 325 million people. Even with slowing population growth, the U.S. Census estimates that we're going to add close to 100 million people by 2060. And that's a big delta, if you will. All of those people are going to need some place to live. We're going to need to build something like 40 million new housing units. We're going to need, even with retail space being used more efficiently today, we're going to need perhaps 1 billion square feet more of retail space, probably 1 billion square feet more of office space, and maybe 2 or 3 times that of warehouse space just to accommodate this growth. And if you look at the United States in the context of the rest of the world, it's pretty dramatic, the differences we're showing. This chart is showing you the absolute increase in population. Now, these numbers are slightly different. These ones come from the OECD, but the point is still the same. The OECD estimates that by the middle of the century, the United States will have added about 85, 90 million people, bigger than any other country. Indonesia's there, Mexico. I did leave India off of this chart. India, believe it or not, is going to add something like the current population of the United States over the next 50 years. And it's just an extraordinary increase in population. So while we're not the fastest growing by any means, the sheer volume of increase is going to be enormous, and it's going to require lots of new construction. And that's just simply a positive for anyone that currently is an investor in the U.S. Property market. All of that new construction, of course, will have to be built at higher and higher costs, and that's very good for existing real estate assets. So now moving into what's really happening in the U.S. property markets today, the very fundamental thing that we are struggling with in the very immediate term is the fact that U.S. job growth is slowing. This chart is showing you average monthly job growth over the prior 12 months. And it has come down steadily from the beginning of 2015, when month in and month out we were adding about 250,000 new jobs. And we're at a point today where it's around 180 to 190,000 per month. Very, very good compared to Europe and many other countries, but slower. This is not happening for bad reasons, it's happening for good reasons. Our unemployment rate's at 4.1%. We're very close to full employment. All of our tenants report that the single biggest constraint they have on their business today is finding the right people. And if you were to look at government data, what they call the Job Opening and Labor Turnover Survey data, what you would see is that we have about 6 million open positions in the United States today, roughly the exact same amount as the number of people who self-report as unemployed. So labor shortage is going to be the constraint near term on office absorption, warehouse absorption, and so on. If we look at the individual property markets on the next slide, what I'm showing you is national level vacancy rates for office, industrial, retail, and apartment, the 4 major property types in the United States. There's been very, very good improvement over the last 5 or 6 years, but if you look carefully at, say, the last 4 to 6 quarters, what you see is a very pronounced flattening in vacancy. A flat vacancy rate, by definition, means that new supply and new demand are in balance, and that is very much where we are. We've never seen a prolonged balance like this before. I've been at AW since 1990. There's never been a cycle quite like this one. Each one's a little different, of course, but we've never seen a prolonged equilibrium like this before. Where it's coming from, of course, is what we call absorption of space, demand for space. This is year-over-year absorption. A couple of things I will point out that are of interest. Retail property absorption turned negative in the 4th quarter of 2017. That's the first time that retail absorption in the United States has been negative in a non-recessionary year. There's a lot of interesting things going on with retail beyond the scope of the time we have this morning, but obviously there's some challenges there. But generally you see stable absorption, somewhat slower, of course, for industrial and apartments over the last year or two, but stable absorption in the 1% to 2% range. And when you match that up against supply data, year-over-year growth in the stock of space, which is on the screen now, what you see is very much in the same range. Couple things to point out here. Retail new supply is very, very low. There's almost no new shopping centers being built in the United States until we move through this period of change that's happening in retail. But the other thing you note here is, one, supply is peaking right now. You can see that by those lines starting to roll over in the very end of 2017, but also it's peaking at much lower levels than in prior cycles. This is all very positive for go-forward property performance. In prior cycles, the U.S. development sector delivered a lot of new space right into economic downturns. Now, none of us knows exactly when the next downturn is going to be, but I feel very confident that we won't have accelerating new development going into whatever that next downturn is, very much in contrast to prior cycles. Before we leave supply, one thing has to be mentioned. The United States as a country is not building anywhere near enough new housing. The red line on here is household formation, in other words, new households. The bars on here are single-family housing starts and multifamily housing starts. You add the two of them together and you get total housing starts. Every year for about a decade before the financial crisis, we built more houses than we needed, the bars being above the red line. And every year since the financial crisis, we haven't built enough. And I would say the single biggest policy problem that almost every city and metropolitan area in the United States is having today is a housing affordability problem. They simply can't deliver enough housing units, and what housing units are getting delivered at the very highest price point in the markets. It makes perfect sense. If you're a home builder, the thing that killed you in the last cycle was having too much inventory heading into the downturn. In this cycle, you're not going to repeat that mistake. You're going to do fewer projects, but you're going to do them at a higher margin point. Land values have gone up considerably post-financial crisis, and the political climate for development has gotten harder, not easier. In other words, more people are opposing projects, particularly in suburban markets. So this is going to persist for quite a while. We see quite a bit of opportunity to build apartment buildings in the United States today. I mentioned NOI earlier, property earnings. This is year-over-year growth in same-store property earnings in the U.S. property space. You can see it's been running about 5 to 6% per year now for about 5 or 6 years. This is by far the longest expansion of property earnings we've ever seen. In the past, there was a lot of volatility to property earnings. That is because in the past, the supply response was much more dramatic than it is today. That simply isn't the case. I don't think we're going to accelerate from here, but I don't think it's going to drop drastically like it did in prior cycles, simply for the fact that we don't have those supply shocks going on. Our expectation is that this line will moderate fairly steadily, but fairly slowly over the next 2 or 3 years, dropping to, say, the 2 to 3% year-over-year growth range. There are some differences by property type, of course. Again, very typical of late cycle in the U.S. property sector. There's a handoff going on, if you will. Apartment earnings are slowing. Apartment earnings always recover the earliest. They have the shortest leases. They're now slowing. Retail earnings are very low for all the issues going on in the retail space. Office property earnings always accelerate latest in the cycle. The leases are longer. You have to wait for those leases to come due and to roll up to the new market rent that exists today. So that's what's happening today. If you were looking at this simply by itself, you probably would be very, very bullish on office. The one thing people very often miss on office is that you have to spend a lot of money. You have to put a lot of your earnings back into your properties in terms of capital to attract and retain new tenants. Today, that's about half of your income in office goes back into the property. So we're less bullish on office than some others might be. I said at the very beginning that all of this would ultimately be determined by what happens to interest rates and to the credit spreads on those interest rates. George is absolutely right. We're at a 35-year low, close to low on interest rates still. But if you look at a shorter time period here, you see two things that have happened to the 10-year Treasury. The first is a very dramatic increase right after the election. Very quickly, sort of the Trump rally got priced in, an expectation for a growth agenda in Washington and so on. Some of that has come to pass, not maybe as much as people had thought, but some of it's come to pass. And then what you've seen is a steady rise up in rates, really from about the time that it seemed like the tax cut bill was going to become a reality. And so we're at an environment now where the 10-year is hovering around 3%. We haven't seen that in quite a while. But more interesting to us in property is the other line, the BAA corporate spread. That bottomed out in the beginning of this year, really very at the end of January, and has started to move back upward. Not dramatically, but there's very few times in history where once this spread starts to widen, that it reverses in the same cycle. The reason we care about this, of course, is that the yield on property is effectively a corporate yield. Our tenants are all corporate tenants and other kinds of tenants. They all have an implicit credit quality to them. The way property is priced ultimately tracks very closely to corporate bonds. So we're keeping a real close eye on that. There's another interesting thing happening in the markets today. Property can trade in a private market, but it can also trade in a listed market, the REIT market, if you will. Sometimes it's cheaper in one market than the other, and then sometimes that reverses. What this is showing you is the relationship of how property is trading in the listed, the REIT market, compared to private. Today, private real estate is about 10% more expensive than it is in the REIT market. In other words, you could buy it 10% cheaper in the REIT market than you can directly. REITs have been a little bit out of favor in this somewhat rising rate environment. There's a belief among many investors that REITs are more interest rate sensitive than a lot of other sectors. I think the data is somewhat mixed on that. At the end of the day, whether it's public or private, it really comes down to how the earnings of the asset are growing and what the growth expectation for it is. But I will show you a couple interesting slides here on just how different the pricing is between the two markets and what it might be saying about going forward. In real estate, we talk about property yields. We call them cap rates. Taking the current income, dividing it by the cap rate gives you the value. What I'm showing you on these charts are the implied cap rate from where REITs are trading today compared to the observed cap rate that we see in what's called NPI, the NCREIF Property Index, the private market, if you will. Today in the apartment space, the spread between public and private pricing is very typical of what we've seen over the last couple of decades. There's not a big story here. You will notice in all these charts I'm showing you that those spreads got very wide during the financial crisis. The REIT market sold off violently in the financial crisis. The private market adjusted more slowly. So about typical spread in apartment. In industrial, the properties are trading at about the same price in both markets. If we look at office and shopping centers, you see some interesting differences though. Many times in the past, the private and public markets for office priced property about the same. They came apart in the tech crash back in the early 2000s. A lot of the real estate troubles in 2000 were tech tenants, and it was concentrated in office. Obviously, they came apart in the financial crisis, and they've come apart again today. Maybe more interestingly, if you look at the shopping center line, you can see again they came apart in the tech sell-off, they came apart in the financial crisis, and they've come apart today. In each one of those cases, however, for shopping centers, look where they adjusted to. There's generally an expectation that public markets are more forward-looking than private markets, and I think the literature on that's probably pretty clear. But in this particular case, each time these lines came apart for shopping centers, they came back to the private market value. The private market value didn't rise to the public market value, it went the other way. So our expectation here is that the REIT sector has overshot on shopping centers, and the values are going to move back towards where the private market is pricing them today. But we'll have to wait and see on that. Getting to the return expectations and so on, the chart at the top of this page is showing you the historical data through the end of 2017. The red line is year-over-year capital appreciation. The blue line is the year-over-year income return. The easy capital appreciation of this cycle is over. We've had the recovery in values from the financial crisis. That's that surge in the red line above the blue. And now we're back in an environment where capital appreciation is roughly around inflation, about 2%. And the income return, the income component of that is a little bit more than 4.5%. The survey data shown on the bottom in that table comes from the Pension Real Estate Association, what's called PREA. They survey all of the investment managers in our space every quarter, and they publish this survey. And this is the one that just came out in March of this year. We're obviously a contributor to it as well. The consensus expected return, and this is nominal return, unleveraged of course, over the next 5 years is 5.2%. Almost all of that coming from income, a little bit on the appreciation side. So in other words, the real estate industry itself expects almost no capital appreciation over the next 5 years. Our numbers for this were slightly higher, but this is where the consensus is. And really what this is signaling is a return back to normal. This is showing you data for the core fund universe in real estate property, high quality, well-located assets, well-leased assets. And what the bars are showing you, the income return and the capital appreciation return over different time periods, and the red line is showing you the share of total return that comes from income. Over very long periods of time in property, 75–80% of your return has come from income, not from appreciation. That's exactly what we think a core portfolio should do for you. Most of your returns should come from income. It should have much less volatility associated with it. And when I get to talking about the fund itself, I'll mention this again, but when we set out to build our core fund, this slide more than anything is what shaped our strategy to produce a fund where most of the return is coming from income. Now, George did ask me if I would share some thoughts on Boston because we have a sort of a Boston-centric audience here. And really what I chose to focus on today is what is it that makes Boston special? You know, the Northeast, New England, it's a tough place to live. It's a tough place to work. We all know that. It's cold. It's expensive. It's very, very hard to get people to move here from, you know, Atlanta or Dallas or places like that. And in fact, most of the population growth is going the other way. So why does Boston thrive? If you look out your window today, you're going to see a very, very vibrant Boston. The Seaport, very vibrant. Back Bay, Cambridge. There's something unique happening in Boston. So I came across this data in this slide. This comes from a Pew Research study. And there's a lot of different ways to rank markets on attractiveness to different demographic groups and so on. I think these guys came up with a fairly clever way to hit on variables that young people, millennials, educated people care about. And on their scoring system, San Francisco and Boston are the two places that smart young people want to be. Even though these places are expensive, even though they're hard places to live. That is a very, very important characteristic for Boston. As everyone knows, we have an enormous concentration of universities here, and we need to and are doing a very, very good job of keeping our young people once they get through our universities here. The other thing that is important for us to do here in Boston, and I'll talk as a hometown rooter here, a lot of cities in the Northeast are losing their workers. They're losing their young people. They're losing what people would sometimes call a brain drain and so on. This is some data from LinkedIn tracking which cities are most losing their young people. And you see some big red circles up in the Northeast, Hartford, Providence, even Pittsburgh. Even with all the great things going on at Carnegie Mellon and robotics and so on in Pittsburgh, they're still losing people. This, while it's negative for the region as a whole, I think does accrue to Boston's benefit. I think a lot of these people, when they leave places like Hartford and Providence, actually come to Boston. They're already wired to be Northeasterners. They've already come to grips with snow and cold and things like that. So I think we do gain at other people's expense here. There really is something special in Boston. Very clearly, Boston is not on this list. So. We need to keep, as always, focusing on the positives for Boston. Now, moving on to the fund that we run on your behalf, the AEW Core Property Trust, what we call CPT. This is data through the end of 2017. The first quarter numbers are just coming out now, and I'll try to speak to those as best I can, keeping in mind that I'm not the portfolio manager, just the research guy. The gross value of the fund today is over $8 billion. Net asset value is over $6 billion. Leverage is very conservative. We use financial leverage of just about 24% today. We're capped by design at 30%. The 24% is right in line with the benchmark. We do have a portion of the portfolio that is called non-core. It's capped by design at 15% today. We're at about 9% of the fund is in the non-core, and that's places to try and generate a little bit more alpha. The dividend, I believe now the dividend is the highest in the universe. There's about 26 of these funds today. I believe our dividend is, if it's not the highest, it's in the top 2 or 3. Very small entrance queue and so on. Now, there's some data here on diversification. By property type, we're underweighted to office. That's a structural underweight. I think we'll always be underweighted to office for some of the reasons I mentioned earlier. We had been very much overweight to industrial going back into 2016, but we had a few offers on some of our industrial property we simply couldn't pass on, so we sold down some of it, and we're replacing that as we go forward. You will see retail there being a little bit of an overweight, and you're probably scratching your head saying, well, he just said a lot of negative things about retail. I wonder what that's all about. The shopping centers that we have, we really believe in. There's a lot of problems vexing retail property today. A lot of it's concentrated in big regional malls. There's a lot of turmoil in tenants. In fact, there's a sort of a generational change happening in tenants today. The shopping centers that we have really serve a purpose for their local trade area. They're all in very high income and high education type markets. Very wealthy people around the shopping center, but more importantly, they serve a purpose in their local community. In many cases, they are the center of those communities today. Lots of restaurants, recreational activities, value-oriented retailers, TJ Maxx, Marshalls are some of our favorite, and of course, grocery stores. And in the multifamily space, we are overweight and will continue to be. Like I said, America's just simply not building enough housing, and that's going to continue for quite a while. By region, no huge stories here. We're a little bit overweight to the south. The southern part of the United States, particularly the southeast, was late to the recovery this time. Usually they're early to the recovery. It's a region that's very driven by the housing cycle. The South had a bigger than average downturn because of the housing crisis in 2007, and they had a later than average start to the recovery. So we've been playing that a little bit. We are structurally underweighted to Midwest. We will continue to be for demographic reasons. And we're almost equal weight to both the East Coast and the West Coast. The five largest markets that we're in are shown there. LA, New York, and Boston are the top three. No surprise there. Some of the biggest and most dynamic commercial property markets in the country. In terms of some characteristics of the portfolio, we have a saying at AW. We like to say that a core portfolio should be a well-leased portfolio. Today, our occupancy is 96%. We're four full percentage points above the index average in terms of occupancy. We do think that's very much a differentiation for us, and it leads. That's a big contributor to our income performance, and I'll show that in just a minute. We have very even turnover in our leases. It averages about 10% a year, a little bit less this year, a little bit more in 19, but it averages about 10% a year. Very, very manageable. Our cost of debt today is about 3.7% with a term just a little bit under 5 years, and almost all of our debt is fixed rate by design. I mentioned the non-core portion of the portfolio a few minutes ago. This is really the key to the next few years for performance in our portfolio. We're showing you our projected same-store earnings, NOI growth for the existing portfolio, which is the blue line, and we're also showing it to you for the existing portfolio plus the properties that are currently under development, all of which are going to be finishing either this year or very early next year. So that's good. There's very little risk to those developments getting completed at this point. But the new portion of the portfolio, the part that's under construction right now, is going to create significant additional income growth in the portfolio. And as I said before, the driver of performance in these funds is going to be income growth over the next several years. No one's really anticipating a lot of appreciation in any. Just some more highlights here. We got fourth quarter returns up there, and then the 1 year returns. We're very pleased by that. The first quarter numbers were coming in a little bit below the index for the first quarter. We're still trying to sort through all the data to figure out. There's quite a few funds that seem to have taken sort of outsized capital write-ups. So we don't fully understand it all now, but we'll have more to report on that later. And then the total returns are shown at the top of the page, but the thing we really try to draw your eye to is in the red here. Counting the first quarter numbers that have just starting to come out now, our fund has outperformed the index on income return basis now for 32 quarters in a row. And if you really believe we're in an environment over the next handful of years where almost all the return is going to come from income, we think our fund is very, very well positioned for the environment that's laying out in front of us. So with that, I'll say thank you. My contact information is on the screen. Of course, you can also contact me through George, or feel free to contact me directly if you have any questions.
Well, thanks everyone for joining us, and thanks Mike for your comments. That was terrific. We hope you have enjoyed this presentation, and as Mike said, please reach out to us if you have any questions, either by email or by phone. Thanks again for joining us.